This episode of Macro Mondays aired live at 12:30 p.m. on Monday, the 3rd of February, 2025.
Hello and welcome to Macro Mondays, powered by Onyx Markets. My name's James Brodie. I'm Head of Learning and Development here at Onyx Capital Group.
My name's Will Cunliffe, a research analyst here at Onyx Capital Group.
Plenty to talk about this week, lots of charts, and we've had, of course, the Trump tariffs have upended the markets. We'll discuss that, the impact they've had. We have equity markets looking to open sharply lower. Crypto markets have been hit hard over the weekend. Of course, gold being seen as a safe haven.
The Canadian dollar and the Mexican peso are obviously falling hard too. DeepSeek, we'll be discussing how that's affecting the US tech market. And we'll also be taking a look at data coming up this week, like non-farm payrolls.
So straight to the tariffs and the impact they're having on the market. This was announced late on Friday. So the UK, European markets had shut. Asian markets were asleep, and Trump announced a 25% tariff on Canada and Mexico, 10% on China. He's also said that European Union is really out of line. And earlier last week, he threatened 100% tariffs on BRICS, attempting to replace the dollar. So this has had a massive impact on the markets. The first impact, of course, was cryptocurrencies. They were open over the weekend. They saw about $800 billion in losses. That's nearly a quarter of their market cap lost. Ethereum was down at 1.37%. Bitcoin was trading down right on support at 91,000. But it's off where I last saw about 10% from Friday's close. We're seeing equity markets, NASDAQ looking to open down 2%. And really the bit of stability's come in. The fact that Donald Trump said late last night at Edwards Air Force Base, I think it was, that he was going to have a call with Trudeau this morning. So the market's pinning a little bit of hope on that. I can't see him backing down. This would be way too early.
Yeah, I mean, I think, a lot of people are hoping that there'll be some consensus reached and tariffs will be unwound, but it's not looking likely. I think Trump's going to want to stick to his guns here and not be pushed around too much.
Yeah, in his last presidency, he was always talking up the equity market, especially on a Friday night during the China tariff negotiations then.
Yeah.
But now clearly this is going to have a big negative impact. He said he doesn't mind about the hit it's going to have to equity markets.
Yeah.
There will be some pain threshold he'll feel,
sure.
But he wants to
for sure. I mean,
have an impact. Yeah,
it's how long it lasts for, right?
Yeah.
So if the Fed projected recently that if tariffs are maintained at the new levels, they would expect core PCE to rise by about 0.7%, and GDP would take a 1.2% hit. So the detrimental impacts to the economy are pretty significant there, and I think that's what we're starting to see priced into the equity market.
Yeah, that's the worst of both worlds. You're seeing inflation going up and GDP falling.
Yeah.
The chart we have here, actually, this is dollar CAD, and you can see how the dollar's much stronger. Canadian dollar's weakening. It's spiked above the previous double top, and it's come back there basically on the news that Trump's going to have a discussion with Trudeau. If there's nothing coming from that, then dollar CAD's going to push aggressively higher, back to the highs, going back to the financial crisis.
Yeah.
And the interesting point with this as well is, how does the Fed react? And it's interesting this morning looking at how the markets are going to open up, because if you have inflation, then in theory, inflation going up, the Fed would need, or more likely to be hiking again. But of course, the impact on GDP says the Fed's more likely to be weakening. And what you had was the 2-year yields opened up 7 basis points higher.
Yeah.
So the market's saying, well, in US, it's going to have an inflationary impact, but elsewhere we see yields falling. An important point with Canada, exports to the US account for 19% of GDP.
Yeah.
For Mexico, exports to the US account for 29% of GDP. That's going to have a massive impact on those economies.
I mean, trade as a whole for the US is about a quarter of its GDP. So, when you start effectively taxing that amount of GDP, that's going to have a big detrimental impact. But yeah, it's interesting with the yield curve. We've seen a bit of a twist flattener where the front is coming up and the back is going down a little bit. And that's really, in my view, that's the market pricing in less cuts from the Fed.
Yes.
I think the Fed will have to pause for much longer. I think now we don't have a cut price until June.
We have
July.
39 basis points priced this year.
Yeah. So and it wasn't long ago that was 2 full cuts priced. Yep. I think last Monday it was 50 bips priced by year end. But I think that the US is resilient. Unemployment's at 4.1%. The Fed don't have to do anything. They don't.
It's
have
not a weak
to
economy,
accommodate.
absolutely.
Whether the hit to GDP will translate into a hit to employment. Labour markets are sticky. They take a long time to react to macroeconomic developments, but a 1.2% hit to GDP is going to have an impact. So
yeah, we will touch on labour markets a bit later. Of course, we have payrolls this week, which adds to the volatility.
Yep.
Interesting point with tariffs as well. The tariffs already been enacted account for 1/3 of imported goods. If Trump does enact tariffs on Eurozone, then that's going to be a big mover as well.
Yeah, and that's pushed the average tariff up from 3% to 10.7%.
And if we move on to the yields, we have the chart here of the 2-year we've just discussed. You can see it's been going sideways now really for several months, but you can see it has pushed up on the open. On Friday night, it looks like it was going to break, it was trending low, looks like it was going to break to new lows, but it has suddenly jumped on inflation fears, trumping GDP fears. Excuse the pun. Bitcoin volatility, I mentioned Ethereum at one point was down 37%. You can see Bitcoin's middle of last week, it looked as though it was going to break higher. Again, this has also been a sideways consolidation pattern for several months. All of a sudden this morning, it tested the lows at 91,370. Again, when US comes in about an hour's time, if we don't see any good news from the Trump discussions with Trudeau, then that will, very good chance we see Bitcoin breaking lower, and that will have a big impact in retail traders again.
I mean, it's an interesting one, Bitcoin, because it's a natural diversifier in the portfolio. So usually, people would be like, why isn't Bitcoin rallying on uncertainty? You might move to it as a safe haven like gold, for example. But I think there's a lot of kind of portfolio managers will be taking profit now on their Bitcoin positions to offset some of their losses in the equity markets. And we've seen that before with gold, where at the moment gold is acting like a safe haven, but that there are risks to that portfolio managers start taking profit to offset some of their losses in other
Personally
sectors.
as well, I see Bitcoin more aligned to liquidity and risk, as opposed to gold as a natural safe haven and a alternative investment.
Yeah.
Which brings us onto the gold chart. Last week, end of last week, it broke new all-time highs. It's trading, last I saw trading at 2,785. The key support it broke out of just below there, 2,790. Again, more uncertainty. I would expect more money to dive into that as a safe haven. This has been trending high. We discussed this over a year ago, that the breakouts in oil from just over 2080, been trending higher, consolidating, breaking again. Seems to be a big winner here.
Yeah, for sure, especially with all the central bank buying that we've seen throughout Q4 last year, really. Had Poland buying, India buying a lot as well, China buying a lot. So, that's going to be really supportive of gold as well.
And the technical traders will love this as well, because they live buying all-time highs. It breaks a new all-time high. They'll have stops just below the key level, in this case, 2,790. So it makes it a great risk-reward investment that trend followers use. Similar to what we've seen, the famous traders, the turtle traders and the Harvest, people like that in the equity market. That's what makes equity trading so popular, trading these types of strategies. We will come back to the markets and the impact from tariffs soon, but worth mentioning again, DeepSeek and how that's upended the AI and tech stocks in the US. Amazing to think that's a week ago. It seems to be
Yeah.
old news now as everything's focused on Trump.
Yeah.
After DeepSeek, of course, we had Alibaba came out with Qwen 2.5 Max, which is even more advanced. By the end of the week, personally, I thought tech across the board would take a bigger hit, but we saw other of the Mag 7 stocks doing quite well. But what we have seen, NVIDIA down 17% and Alibaba up. Was it Alibaba up? Yes, 17%. So we're seeing a bit of rotation here towards Chinese AI, OpenAI stocks. The chart here we have is NVIDIA, and you can see how that's clearly broken through support. It's been going sideways for many months now, and it's broken the support. But what's more concerning really is retail bought $900 million of NVIDIA stock last week. So when we see what we'd call the institutional investors pulling out, we're seeing retail going back in. Again, not only is it not gone, it's gone sideways for about 8 months. It's now going down, and retail, it's the age-old classic of retail adding to losing stocks. That's how they get hurt so much.
Yeah, for sure. I mean, it's just another
risk management.
example. It's just another example, really, of China's comparative advantage. The US imposes a lot of sanctions on China. Those include the lithography machines that come from ASML that are used to produce the chips, or NVIDIA chips themselves. They've limited exports to China, and this just creates a gap in the market for Chinese competition. And apparently, DeepSeek are claiming they did it for like $5 million. They built this. Whether that's true or not is still to be seen. I suspect there might have been a little bit of a helping hand from the CCP, but who knows? Nevertheless, it really shows how the same thing that's happening in the electric vehicle market at the moment. China's comparative advantage is pretty mega.
And again, a key point here on risk management. Adding to losing trades is fatal for trading for P&Ls. So that's one to watch here. If it starts, it's breaking support, it's looking like a downtrend. Institutional investors have taken profit and are out that market.
Yeah.
Bit of data we had last week. We had US consumer confidence came in slightly weaker than expected at 104.1, expected at 105.8. So it's lower than expectations, lower than previous forecasts. And household income in 1 year continues to plummet. Expectations of household income in 1 year continue to plummet. Not good for economic growth because consumer confidence is falling, spending's falling.
Yeah.
GDP came out as well. Q4 GDP lower than expected. But to be honest, this is just old news. Came in at 2.3%, expected at 2.6. Q3, even DeepSeek now is old news from a week ago. The market's moved on.
Sure. I think the key thing with the GDP release was within the headline statistic that the key drag was fixed investment. And I think it ties in a lot with the worsening consumer confidence we're seeing. We're seeing rising consumer credit defaults and mortgage applications declining. It's all speaking towards a tight credit market and overly restrictive rates. And that will pass through to the real economy at some point. But for now, unemployment's at 4.1. So,
And also PCE came in last week, dead on expectations. That came out on Friday, but again, that is now completely old news. As we said, we're looking at the tariff implications on inflation. The dollar index this morning has suddenly jumped higher. It had a rally, 9% rally in Q4. It was selling off after Trump's inauguration. And all of a sudden, I think people didn't really believe the tariffs were going to happen. Now they're happening. All of a sudden, you can see a massive jump. Speculators are longest the dollar they've been since 2019. So a bit of relief for traders here. And we've had some weak data out of the euro area. So we have some slides on that. But it looks like euro dollar is going to be heading to parity pretty quickly.
Yeah.
We mentioned US housing. Existing home sales fell 5.5% in December. New home sales fell 4 million in 2024. They're now the lowest they've been since 1995, when the population, interestingly, was 70 million lower. Also, first-time buyers accounted for just 24% of purchases. This is a record low. So you can see, as you said, it's financial conditions are tightening.
Yeah.
It's really beginning to have an impact.
Yeah, for sure.
Interestingly, house prices, core logic 20-city house prices up 4.3% year on year. You can see from the chart, house prices, the rate of ascent is falling. The national house price index as well, up 3.75% year on year. So house prices are up, but the pace of rise is falling. Again, financial conditions are impacting, less transactions taking place, less mortgaging applications. It just takes time to play out.
Yeah. But it definitely does feel like the market's starting to roll over. And unless we get interest rates falling and that translating into a reduction in mortgage rates, because at the moment we've had 10-year yields, they're off their highs, and that's kind of what sets the 30-year benchmark fixed mortgage rate. But mortgage rates have stayed pretty steady at like just above 7%.
Yep.
And don't want to budge from there despite the 10 years coming off a little bit. So yeah, we need to see that pass through really.
Again, we mentioned this last week, but what's interesting with economic data, for instance, and trading bonds and trading equities, it all happens instantly.
Yeah.
But house prices takes months. It's a market. It just takes so long to play out.
Yeah.
And really, it really starts to speed up when unemployment rate starts to go up, when people then can no longer make the mortgages, they're forced to sell properties. That's when you start to see the increase in the pace of price movement.
Yeah.
A big week last week for central banks as well. The ECB cut 25, the Bank of Canada cut 25. Fed was on hold, but we had some key central bank speeches. Jeremy Powell, head of the Federal Reserve, said the economy is strong overall. Economic activity has continued to expand at a solid pace. He also said inflation remains somewhat elevated, but labour market conditions have cooled, yet remain solid. Activity in the housing market sector seems to have stabilised. And really key one for me, he said asset prices are elevated by many metrics right now. You remember with Greenspan, he talked about irrational exuberance. This was back in the 90s, I think, before you wouldn't quite remember that. And the market doesn't take much notice.
Yeah.
Interesting one from the Bank of Canada. They warned about tariff uncertainties, saying it clouding the economic outlook. And from the Bank of Japan, BOJ's Himino says they will raise rates if the economy and prices move in line with forecast. And BOJ Governor Ueda said it will continue to hike rates if economy moves in line with forecast, but underlying inflation is still somewhat below 2%. Interesting there, the Bank of Japan, the one G7 central bank expected to hike this year, we still have 29 basis points of hikes priced in, so just more than one cut. Again, what we have the chart here, I highlight this one a lot. This is the dollar yen is orange, and the white line is the 2-year yield interest rate differential. So 2-year bond, US bond yield minus 2-year Japanese yield. You can see how highly correlated they are. It looks like, though, the dollar yen has some catch up to play to the downside.
Yeah, for sure.
Some weak data in Europe, and the ECB, the market's pricing 88 basis points of cuts this year, including 27 basis points on the 6th of March. Interesting, the market's starting to sniff at 2 cuts.
Yeah, I mean, the euro area more broadly needs a lot of help from monetary stimulus. GDP growth quarter on quarter in Germany was minus 0.2%, worse than estimated minus 0.1%. In France, it was minus 0.1%, worse than the estimated flat. So yeah, the economy is looking really bad, and we've recently seen the German government revise down its projections for GDP growth this year. They were expecting a little bit above 0% growth, but I think it could be a little bit worse than that, to be honest. The industrial complex in Europe really has struggled with energy recently, energy markets. We've seen no wind generation in Germany or even here in the UK. We recently had energy prices spike to over £1,300 per megawatt hour because we have so much wind capacity, but when the wind doesn't blow...
There's no wind. These green policies are not looking so clever.
No, exactly. And that's really hurting industry. Like we saw INEOS already pull out from the UK, and they were blaming energy prices for that. So yeah, there needs to be some investment in baseload generation in Europe in order to support the industrial complex. Otherwise, we're not going to see much in the way of economic recovery.
Yeah, certainly our power traders in Zug are adamant we're going to see recessions in Germany and France this year, and now it's beginning to get played out with the data. Also in Germany last week, we had retail sales estimated to be up 0.2%, month on month down 1.6%. That's a massive miss. Unemployment rate has gone up from 6.1 to 6.2%. And French inflation came in lower than expected, down 0.2% month on month. So that's still up 1.8% year on year. That's still positive. But what we're seeing in the shorter term timeframes, it's looking like there's signs of deflationary issues creeping in there. Yeah. Personally, I think the ECB need to cut harder and faster. And as we just said, the market's pricing 27 basis points of cuts from March 6. The market's saying basically they'll cut 25. There's a chance they cut 50. Yeah. Christine Lagarde also said economy set to remain weak in the near term and manufacturing continues to contract. So she's pretty pessimistic as well. And the chart we have is euro dollar. You can see, again, interesting move this morning. It opened with a gap significantly lower, broke the recent lows and has just risen, just held above that. But again, any more negative news out, or really less than that, I'd say if there's no positive news, then we're going to see more risk aversion, risk off, as people like to call it. I think euro dollar going to parity will be another signal. I think we looked at dollar yen going down, so that means actually the better trade in that case would be euro yen lower. Yeah. Australia, we had some weak data as well. The market's now pricing in back-to-back rate cuts. Again, the RBA, Reserve Bank of Australia, was one of the most conservative and slowest to raise rates. Now suddenly they're the first to be cut. The last to be cutting. 89 basis points of cuts priced in this year. Downside inflation surprise last week. And the chart here, actually, this is Aussie yen. This is highly correlated with S&P, risk on and risk off. And the reason we talk about it's just breaking the longer term trend line as well. And the reason I talk about this is, again, interest rate differentials. The Japanese curve base rates in Japan are at 50 basis points. There's basically, the curve is 1 year out pricing another 29 basis points of hikes. There's no room really for central bank to cut maybe 25 or 50 if there's a recession. But of course, Bank of England, the other G7 countries have much more room to cut rates. So what happens when it's risk off? The yen benefits from interest rate differentials contracting. The UK, more weaker data. And interesting here, you can see private payrolls have fallen 159,000 over the past 6 months since Labour have come in. That's the equivalent of US payrolls falling $140,000 a month. If that came out in the US, suddenly the market would be pricing aggressive cuts. In my view here, the Bank of England will be having to cut rates sooner and harder than the market's pricing.
Yeah, definitely. I think the labour market in the UK, from what we can tell, is struggling. I mean, the ONS has had some questionable counting. I think at one point they were missing 1 million jobs, and they realised. So
it's madness.
So yeah, if you can trust the ONS's numbers, for sure, we need to get cutting.
Yeah, we do have one cut fully priced for March. But we have the terminal rate in the OAS this year, 3.89%. I think basically if the data comes out weaker, the market's going to price OAS terminal rates at the end of the year a lot lower.
Yeah. It'll be interesting to see what comes out in the NPR later this month.
Yeah. And on that, sterling yen also trending lower against the interest rate differentials. Well, it's trending lower, the orange line here, but you can see the interest rate differentials in white are moving aggressively lower. So again, another favored trade there, interest rates implying that sterling yen is going to continue lower and has quite a long way to go.
Crude's been quite interesting recently. WTI opened up 2% higher and Brent rose about 1%, but both kind of retraced a little bit following Trump's tariffs. Really what's key here is that we shouldn't really be looking at this as a supply disruption. It's more of just a price distortion. Someone has to really pay for the tariff, and it's seemingly looking like it's Canadian producers. Canada, they don't have that much export capacity. They can ship stuff off to Asia via TMX, but that's pretty low. That's just over 400,000 barrels per day. Whereas they're sending like 4 million barrels per day to the US. So they have to place those barrels somewhere. They're probably just going to discount. We've already seen WCS, so the Canadian benchmark relative to TI, that differential widened to minus 15.50 from $14 around on Thursday. And, finding a way to navigate around the tariffs is not only expensive, but it takes a long time. So if you want to ship barrels from Dubai, it's not just you've got to pay for the shipping, you've also got to wait for those barrels to arrive. So I think, for the time being, we're going to see Canadian crude trade at a bit of a discount. Dubai was really interesting this morning. There was only one partial traded in the window today, which is quite a shift from January, December, November, when Totsa was launching the bull play. They seem to have.
Yep. So while volatility is spiking in other markets, you've seen completely opposite in Dubai this morning. And interestingly, the chart here, we've talked about these long-term trend lines before. The resistance line, well, that broke when the Brent price went to the upside. Resistance lines, when they break, typically come support. And you can see for the last 6 days, the price action's just been sitting on that support line. But again, pretty quiet one in crude this morning.
Yeah.
Central bank OAS pricing for the next 12 months. You can see, again, this is interesting because this will, I guarantee, be very different in a week's time. We're seeing so much volatility. The OAS, what markets price, and you're going to start seeing markets move different directions. The Fed might reduce the number of cuts priced, where ECB, Canada, will probably see more cuts priced.
Yeah.
Interesting point we should mention, of course, as well, is as those currencies weaken, that tends to offset some of the tariffs. And that's one thing the PBOC could do in China, is let the yuan weaken considerably, which would probably irk President Trump even more.
Definitely. China are going to be looking for ways to retaliate, and I think that would be one compelling way to do that, to boost exports.
It's not a good word when you talk about retaliation.
No.
It's not good for the global economy. Interesting times and plenty of volatility.
Mm.
So we mentioned the equities are going to open lower. The Nasdaq's going to open, at the moment, it's looking like it's going to open down 1.9%. I have the chart here of the E-mini, the Nasdaq future. Of course, the cash market hasn't opened. So you can see here the impact of the weekend's news has had in the future. Here, you can see a clear support, the previous lows at 21,000. What we did have last week, mega caps did pretty well, actually. Apple, Intel, Visa rose by 3%, 3.7% and 1.2% respectively. Interesting with Apple going up, though, it's had just 0.3% revenue growth over the last 3 years, while we've had 15% inflation in total, and iPhone sales are negative year on year. An interesting chart with Tesla as well. It's in a converging triangle here. You can see the market's going to open lower for sure, but Tesla's revenues grew just 1% in 2024, while the stock price gained 63%. What I find more amazing is looking at price to sales ratios. Tesla's price to sales ratio is 12.7. The next highest, BYD, is just 1.1, Toyota 0.9. So I think a lot of people are pinning their hopes on Tesla resolving the whole driverless cars.
Yeah, and I think it's also, Musk's relationship with Trump. He's probably going to have some favorable say politically. It's seemingly really quite overly priced. The BYD, for example, far more competitive. The only problem is, are people buying them? I'm not seeing any in London. I'm not seeing any BYDs. Or Chinese EVs more broadly, even though we're seeing all of these massive sales statistics coming out of China. Sales were a little bit softer in China in January though, so perhaps we've seen a top out in the Chinese EV market. Interesting.
Of course, with Elon Musk's relationship with Trump, it brings into question how if there'll be extra tariffs on Chinese cars, because that will decimate the US car industry, as we'll see what's happening in Europe.
Yeah.
But certainly on that chart, Tesla, you can see where the key support comes in. Again, retail traders, beware. When the market's trending down, it likely continue trending. Buying dips is incredibly risky. And with retail traders, beware, volatility and risks are rising. You can see here retail, I mentioned earlier, the net flows last week into NVIDIA were a record from retail investors. Well, the stock has clearly broken support, so be incredibly wary in these markets. I mentioned last week that Interactive Brokers had said on CNBC, today is the highest level of margin we've ever had in our accounts. What we have now is some key markets trending down. We have volatility spiking. So again, I just warn everyone to beware. These are certainly very risky and volatile markets. And what data we have this week? Key data again will be US payrolls. US unemployment 4.1%, incredibly low. The economy, as we said, is strong. Again, compare that with Germany, unemployment of 6.2% and going up. But one thing to think about as well, Donald Trump, the administration has offered 2 million federal workers the chance to take a deferred resignation with a severance package of 8 months' pay and benefits. And it's thought 5 to 10% of the workforce will accept this. So that's going to immediately have a negative impact on payrolls. But of course, for the last few months, I don't know exactly how many, but payrolls has been driven by government.
Yeah.
And private payrolls in the US as well as the UK are falling. If Elon Musk starts his plan to reduce the government sector with Doge and government spending, then that will have an impact on fiscal policy. That will have a negative impact on fiscal policy, I should say, negative impact on employment. And this has to be a long-term tailwind to think about.
Yeah, for sure. I mean, I guess the question is, can Trump's tax agenda open up the private sector and create more employment there and have a reallocation of resources from public to private sector? I think that's what they're going for, but that takes time.
And also the onshoring of businesses due to tariffs. But again, that takes time to play out as well.
Yeah.
Problem with tariffs, it has an immediate downside impact for a potential longer term positive. But
yeah. And I mean, last time when Trump imposed tariffs on steel, for example, you saw an initial increase in revenues for steel production, but employment didn't really change in the steel industry.
And you're just subsidizing an inefficient industry.
Yeah.
Protecting, I should say.
Yeah. Yeah, exactly.
So data this week, we had actually this morning, we had the Chinese Caixin manufacturing PMI, which came out, I believe, weaker than expected.
Yeah, it came out at 50.1 when expected 50.5. So just clinging on to expansion, really. Just about, yeah.
In the US this afternoon, we have ISM manufacturing PMI. Again, normally that would be a key piece of data, but I think the market's going to look straight through that.
Yeah.
Tuesday, JOLTS employment data. Fairly, not a key piece of data. Again, Wednesday, ADP, not key really. But we also have US services PMI on Wednesday, China services PMI, UK and Eurozone PMIs as well. So that's a big day for data there. Thursday, Bank of England, 25 basis points expected. Any chance they go 50? We've not had a central bank surprise for a long time, have we?
No. I think they'll go 25. I don't think Bailey's want to shock the market.
They don't like to shock markets, do they?
No.
Markets tend to panic. What does the central bank know that we don't?
Yeah, exactly. And I think especially we've seen a recent bear market in gilts. Also, sterling was under pressure recently, so they're just kind of stepping away and wanting to reassure markets at the moment. I think more so than cutting 50. I think 25 basis points makes sense.
Be interesting to see what their predictions are as well going forward.
Yeah, I expect probably downward revisions there.
Then on Friday, the big one, US payrolls. We have payrolls out of Canada as well. Also this week, 20% of S&P 500s report earnings. So it's the biggest week of data, but that's largely insignificant almost because the Trump tariffs has taken center. Headlines, and we're trading really, as headlines is the right word, we're trading by headlines, which makes it so hard.
Yeah.
We know when economic data is coming out, and when you're trading off that, you know what to expect, when to expect. But now it's headlines and we just don't know.
Yeah, especially when a lot of the headlines are relating to Trump's policy. You never know what he's going to do.
Yeah, he can change, he can flip-flop in an instant as well.
Yeah, completely.
So there you go. A few months ago, we wanted volatility. Now we've got too much of it. Be careful out there. Lots of risks. Hopefully you've enjoyed this week's Macro Monday. Next week, we'll be hosting it from Singapore, where we're doing some training with some of our clients. Have a great week. We look forward to seeing you then, and good luck. Beware of the volatility. Thank you very much.